Welcome to Stimulus Assistance for Business Impacted by COVID-19, presented by Chugh CPAs. We are going to be talking about COVID-19 related stimulus assistance for business package. Our speakers on the panel are Mr. Kisle Banka, partner and CPA and head of Santa Clara office. Gulshan Chatta, attorney at Chugh CPAs, Chugh Attorneys. Khushbu Doshi, CPA and team lead for Chugh CPAs LLP. Asha Inamdar, CPA, team lead for Chugh CPAs LLP. Jyoti Jhaveri, accounting team lead for Chugh CPAs LLP. Pujasri Vastav, senior accountant for Chugh CPAs LLP. Bhakti Subha, partner and CPA at Chugh CPAs LLP. And Vikram Subramaniam, attorneys at Chugh Attorneys office. We're going to start the panel with economic packages made available to us, and one of them is economic injury disaster loans. Ms. Bhakti Subha, a partner and CPA with our firm, she is going to be talking about EIDL loan. Bhakti is also a member of BVP and also volunteering her services to SCS. Bhakti, would you answer the question, what is an EIDL loan, and explain?
Sure. Thank you, Subhash Bhai. Jai Shri Krishna, everyone. So I know there's a lot of noise and confusion going around the EIDL loans. Let me briefly tell you and explain you about the EIDL loans. The CARES Act had appropriated $349 billion for the SBA programs, which is the PPP, and the Economic Injury Disaster Loan Program, which is the EIDL. The initial funding, by the way, has already been depleted, and the second round of funding of $480 billion has already been approved last week. EIDL is a low-interest federal loan funded by the SBA to the businesses suffering due to the pandemic COVID-19. EIDL is available to small businesses and private non-profit organizations with 500 or less employees, self-employed individuals, and independent contractors. These loans are also available to businesses in certain industries with more than 500 employees, subject to the SBA size standards, which is based on the average annual receipts or the average number of employees. The loan can be applied during the calendar year 2020, and it has to be applied directly with the SBA. The loan is available up to $2 million at 3.75% interest rate for businesses and 2.75% for nonprofits. It is a 30-year loan, and the first repayment can be deferred for 12 months, though the interest will be accrued. These are essentially working capital loans that are to be used to pay eligible expenses like payroll, rent, mortgage, amongst the others. These funds cannot be used for the expansion of the existing business. 20% or more owners must give personal guarantee. Though loans up to $200,000, there is no personal guarantee needed. The CARES Act also provides for the emergency advance, which is the $10,000 advance. We are getting a lot of questions around this. The amount of advance is going to be $1,000 per employee, max of $10,000. The advance has to be applied for at the time of EIDL applications. If the advance is used appropriately, it is forgiven. Yes, the advances are taking time to be funded than initially what was expected, but we are starting to hear a lot of our clients have started to get the advance, which is still restricted to $1,000 per employee, but we are hearing that it is coming in. In general, there has been a long delay in processing the EIDL loans and the advances due to the overwhelming applications being received and the PPP funding that is being given priority. We can call the SBA to check the current status. The response time is very less. Important to note is that your application number for the EIDL should begin with 36. And if that's not the case, maybe you have to reapply. You are probably using one of the old application forms. Businesses can apply for both EIDL and the PPP loans as long as they are used for different purposes. There is a very good news for the businesses having existing SBA covered loans. Under Section 1112 of the CARES Act, the SBA will pay the principal and interest and any other associated fees for a period of 6 months beginning April 1, 2020. SBA will also make payments for the covered loans that are made between April 1st, 2020 to September 27, 2020. These prepayments are not to be treated as income. EIDL loans are not available to 501c3 organizations with an exception to the faith-based organizations. Faith-based organizations can still apply for the EIDL loans. The loan terms will remain the same as any other private nonprofit organizations. Concluding this, EIDL loans are currently delayed, but the businesses are already starting to see these communications to come in. Please call the SBA to get the current statuses, and that will help to move the proceedings further. Over to you, Subhash Bhai.
Thank you. Next one, another program is Paycheck Protection Program loans, PPP loan. Ms. Jyoti Jhaveri, accounting team lead, will be addressing this issue and explain to us what is the PPP loan. Jyoti, would you help us?
Sure, Subhash Bhai. The Paycheck Protection Program is another stimulus grant under the CARES Act. It's a loan initiative designed to provide funds to small businesses to retain employees through this COVID-19 crisis. As we all know, payroll is the biggest expense and the #1 pressure for most businesses right now. Congress has enacted the PPP loan as a great option to keep employees on payroll and avoid terminations and layoffs. The PPP loan is available for any small business with less than 500 employees that was in business on or before February 15, 2020. They could either be an S Corp, C Corp, or an LLC. This program is also introduced by SBA, but unlike EIDL, these need to be applied through approved banks or lenders. Lenders who are authorized to make loans under SBA's existing 7A loan program are automatically eligible to participate. Other lenders have been added by the Department of Treasury and SBA, including fintech companies such as PayPal, Square, Intuit, etc. Next question that could come to your mind is, how much can I apply for? The answer is formula driven. The amount you qualify for is based on 2.5 times your average monthly payroll costs. Your average monthly payroll is calculated based on your prior 12-month payroll costs. However, the total loan amount is capped to a maximum of $10 million. So for computing the payroll cost, we would need to include the monthly payroll, employee benefits, state and local payroll taxes. However, the salary amount over $100,000 is not considered as payroll for any employee. Once the loan is approved, you must utilize at least 75% of the loan proceeds for payroll, and the balance 25% can be used for making payments like rent, mortgage, and utilities. The PPP loan can be availed at an interest rate of 1% for a term of 2 years, and it also does not need any collateral or personal guarantee. In addition to small businesses, even the sole proprietors who report income on Schedule C in their personal tax return, and independent contractors, part-time workers who collect 1099 miscellaneous forms are also eligible to apply for these loans. The requirements are straightforward. The only stipulation is that you must be in operation on or before February 15, 2020, and that your business must have been adversely impacted by COVID-19 pandemic. If you started your business after that date, you will not be eligible for this program. Most of the loan terms remain the same as I explained before. However, since you don't have employees, you won't be reporting your payroll cost for the PPP loan. Instead, you'll be reporting your net business income, which is reported on Schedule C. The maximum loan size for independent contractors or sole proprietors is going to be 2.5 times your average monthly 1099 miscellaneous income or the net self-employment income for the past 12 months. But if your annual net profit is over 100,000, you may claim only up to 100,000 on an annualized basis. Once the loan is approved, you must utilize at least 75% of the loan proceeds towards replacement of your normal 1099 miscellaneous income or net self-employment income. And the balance 25% can be used for making payments like mortgage, interest, rent, and utilities in order for the loan to be forgiven. Nonprofit entities are also eligible for PPP if they meet the program's requirements, and if they are classified under the tax laws as a tax-exempt nonprofit organization described in Section 501c3 of the Internal Revenue Code and under Section 501c19, which is a tax-exempt veterans organization. Lastly, as you may all know, the Paycheck Protection Program exhausted nearly $350 billion, which was set aside for low-interest loans to small businesses in just 14 days. So Congress reached an agreement and Senate passed the bill last week to add an additional funding of $310 billion for PPP loan. This is great news for the ones whose PPP loan application has not yet been processed and still stand a chance to avail of this loan. I hope this information is useful and helps you in these extraordinary times. Over to you, Subhash Bhai.
Thank you. The most attractive part of PPP loan is its forgiveness. And forgiveness makes it, instead of loan, it becomes like a grant. This is a more complex subject matter. And in order to explain this complex subject matter, in a simplex manner, is Mr. Kisle Banka. Kisle is CPA and partner as a head of our Santa Clara office. Kisle, would you explain us the loan forgiveness program?
Yes, sir. Subhash bhai, thank you. Hope many of you have started getting PPP fund. Getting the PPP fund was important, but forgiveness of PPP is equally important. And if you don't plan for it, you will find some liability sitting in your balance sheet after the end of eight-week period. Since many of you know that PPP loan is forgivable as long as the loan amount is spent during 8-week period in salary, rent, utilities, and mortgage interest. This 8-week period will start from the day you will receive the fund in your bank account. So out of total loan amount, at least 75% should be spent on the payroll, and the remaining 25% can be spent on other expenses mentioned earlier. We got a lot of queries from many of our clients if salary paid to H1B and L1 worker will be part of forgiveness amount. Yes, they will form part of the calculation. However, if you have paid any amount to 1099 subcontractor and foreign workers, that will not be considered for this calculation. So this PPP forgiveness can be reduced by two reasons. The first, it can be reduced if your number of employees have reduced. And for this purpose, we need to compare the average number of employees during 8-week period immediately after getting the fund versus couple of other period during 2019 and January and February of 2020. And if the number of employees have reduced, then proportionately there will be a reduction in the forgiveness amount. And the second reason of the reduction can be pay cut over 25%. And this requirement is going to be assessed individually for each employee. And if their employee payroll over 8-week period is less than 75% of the pay they received during most recent quarter, then the forgiveness amount will reduce for difference amount. Many of our clients have asked, what if this PPP loan amount is forgiven and then is it going to be taxable? So the good news that from tax front, the forgiveness amount will not be taxable. Usually the forgiveness amount from loan is cancellation of debt and is subject to tax. But in this case, especially there is a provision that this will not be subject to tax for federal purpose at least. For state, we don't have any clarification. Hopefully we'll hear from state soon about the taxability. So after this 8-week period is over, you need to apply to bank where you have taken the loan for forgiveness. And along with the application, you need to provide a lot of documentation. For example, documents verifying how many full-time employees you have on the payroll and their pay rates, payroll report, quarterly reports, 941s, documents verifying any retirement, health insurance contribution, document verifying your eligible rent, utilities, etc. So be ready with these documents as you go during this 8-week period. And lastly, there could be some tax planning opportunities so that you can maximize your forgiven amount. And so as you know that this 8-week period starts from day you have received the loan. So it is quite possible that 2 months of your payroll cycle will not fall into this period. So you may have to work around your payroll cycle and adjust it a little bit so that the maximum number of payroll cycle can be accommodated and the maximum amount of loan forgiveness can be calculated. You can also plan to prepay some of the bonuses, commission that are due in coming days. Make sure that all your payroll taxes are debited from your bank account. Sometimes payroll agencies, if the amount is small, they pay after a certain time because they are not due immediately. So you may have to talk to your payroll agency and ensure that payroll taxes are debited from the bank account during this 8-week period. And also you need to ensure that your rent, utilities and other eligible expenses are paid on time covering this 8-week period. This is pretty much from my side on forgiveness. I'll be happy to answer any questions on the chat.
Thank you, Kisle. Along with all other programs, another one is payroll tax credit available to small businesses to assist them in these difficult times. Ms. Asa Inamdar, CPA and team lead of our Chugh CPAs LLP, will be answering and explaining payroll tax credits. Asa, would you explain all different tax credits available to small businesses?
Sure, Subhash bhai. The Employee Retention Credit under the CARES Act is a fully refundable credit that covers up to 50% of the payroll per quarter, including the health benefits for each employee. Wages between March 13, 2020 to December 31st, 2020 qualify for this credit. The credit is allowed against the employer contribution of Social Security taxes. The maximum compensation amount for this credit is capped at $10,000, essentially making the credit up to $5,000 per employee. Any excess credit exceeding the liability for Social Security taxes for the quarter is refunded, hence it is fully refundable. To be eligible, the employer should have faced some kind of an economic hardship as a result of partial or a full suspension of operations or a significant decline in the gross receipts in the pandemic. Significant decline means a decline in a period beginning with a calendar quarter of more than 50% compared to the same quarter of the previous year and ending in a calendar quarter with gross receipts exceeding 80% of the gross receipts for the corresponding previous year quarter. Employers with more than 100 full-time employees in 2019 can claim the credit for wages paid to only those that did not work during the hardship. So that means it's basically based on the number of employees and the credit guidelines have accordingly been set. Now, employers having 100 or fewer full-time employees in 2019 could use the deduction even if they weren't closed or even if the employees were not working during the hardship time frame. The credit can be availed as long as the PPP loan has not been availed. Credit should be claimed on the form 941. Now note that 50% of the qualified wages paid for the period from March 13, 2020 to March 31st, 2020 should be included along with 50% of the qualified wages paid for the second quarter of 2020 on the form 941 for the second quarter of 2020. It cannot be included on the first quarter of form 941. The tax credit for paid sick leave or the FMLA under the Families First Coronavirus Response Act, that is FFCRA. An eligible employer cannot receive credits for qualified leave under the FFCRA and the employee retention credit under the CARES Act for the same wages. A refundable payroll tax credit equal to 100% of the emergency paid sick leave or family medical leave paid for each calendar quarter can be availed. The credit is to be claimed against the employer's share of Social Security taxes only, that is 6.2%, and also on the employer's share of Medicare taxes, that is 1.45%. If credit is more than the allowable limit, the excess is refundable to the employer, even if it is over and above the payroll tax liability for that quarter. Qualified sick leave and family leave wages should be paid for the period from April 1st, 2020 to the end of December 2020. Self-employed individuals can also claim self-employment tax credit for the same period. Government employers are also eligible. The emergency paid sick leave is limited to 10 days per employee for this credit, and the qualified family leave is capped at $200 per day and $10,000 per employee for all calendar quarters. Now let's take a look at the deferral of certain payroll taxes under the CARES Act. 50% of the employer portion of Social Security taxes and Medicare tax liability of eligible employers for the period from March 27th, 2020 to December 31st, 2020 can be deferred until December 31st, 2021. And the balance 50% can be deferred all the way until December 31st, 2022. Employers receiving a PPP loan can also continue to defer the payment of payroll taxes only until the loan is forgiven. No special election is needed by the IRS for claiming this credit. Just let your payroll processor know and they will take care of it. That's it from me. Over to you, Subhash bhai.
Okay. Another program for mid-size and large businesses called Main Street Lending Program. Ms. Pooja Srivastav, MS in taxation and enroll agent and senior accountant at Chugh CPAs LLP, will be explaining the difference between Main Street Lending Program and PPP, and also explain Main Street Lending Program. Pooja, to you.
Mr. Subhash, apart from the popular PPP and EIDL programs, there are some new noteworthy programs that have been introduced on the 9th of April by the Federal Reserve for the companies that have been impacted by the COVID-19. And like the name suggests, it's called Main Street Lending Program. It's kind of mostly Main Street, which means medium-sized versus the big Wall Street. That's how the name has been derived. This is designed for companies which had a good financial standing at the end of the year 2019, which means you had revenue and you had a good amount of liquid in your balance sheet. That's what this is designed for. This has some math and some calculation that goes with how the loan will be given to you. So, of course, we are all here to help you out with that. There's another program called the Coronavirus Economic Stabilization Act. This is called the CESA. And this is particularly designed to help the aviation-related businesses. I'd like to walk you through some of the differences as it's stated on the slide, so you can look at it. The Main Street program is basically designed for small and medium size. Like I said, you need to have less than 10,000 employees, and the revenue should be 2.5 billion and under in 2019. For the CESA, it's designed for a mid-sized company again, between 500 to 10,000 employees. You can work around a passenger aircraft or cargoes or something to do with national security. The interest rate that is applicable to both these loans are 2.5 to 4% for Main Street and up to 2% for CESA. The loan term is 4 years for Main Street and 5 years for CESA. The maximum loan that you can get for Main Street is 25 million. But it has to be minimum 1 million. And there is again a calculation to that. You can contact us at Chugh firm to help you and see how we can work around that. For CESA, there is no minimum or maximum. However, both of these loans come in with some inbuilt restrictions. We've put in a few here. There's a lot more. And I think if you want to delve into and understand more about the Main Street lending, please contact us again. So you need to retain 90% of your workforce till September 30th in both cases. The executive compensations are restricted in both cases. And for Main Street, you need to make sure that you have no outsourcing abroad. The deadline for these applications are 30th September 2020 for Main Street and 31st December for CESA. The eligibility, if you've already applied for PPP, that could be a very popular question. Yes, you are eligible to apply for the Main Street. And for CESA, no. Loan forgiveness is not applicable for either of them. We do not have any dates as of today. And there's a lot of talk about specifically the Main Street that's going on in the news. So we cannot right now predict what time it will open. Of course, there's a deadline to it. And if you have a banker and a good relationship with your banker, you might want to start the conversation on Main Street. They do have underwriting already done for you. So there is a case already ready and they can probably help you and let you know more about it. The next slide that we have, it talks about Main Street and PPP, and it's just a way of looking at the comparison between what you actually have right now in the market, which everyone's applied for, and what probably you're going to get in future. It's a very simple comparison here. You know, you're looking at 1% interest and then up to 4% here, 2 years here, and 4 years of the term. And the minimum loan amount for PPP, as we know, is nothing. Again, here the maximum is increased by 10 million for Main Street, and there is forgiveness. That's a huge difference in the PPP, and there's no forgiveness for Main Street. And so Main Street is mostly designed for corporations that are or were making profit up until the last quarter of 2019. But you do get a little bit of benefit with 10,000 employees. So it would be something to watch out for, these programs, and let us know if we can help you in any way. Back to you, Mr. Subhash. Thank you so much.
Okay. Now, along with all these different things, IRS has changed some tax deadlines and added some more deductions. Who is better suited to explain all this than Ms. Khushbu Doshi, CPA and team lead in Santa Clara office at Chugh CPAs LLP. Khushbu, can you go over all the new tax deadlines and new deductibles?
Ms. Subhash, thank you so much. The Treasury Department and Internal Revenue Service announced on 21st of March that the federal income tax filing due date is automatically extended from April 15, 2020 to July 15, 2020. About 37 states have adopted the same filing date of July 15th. Other states with different deadlines are Virginia, New Hampshire, Mississippi, Iowa, Idaho, and Hawaii. Taxpayers can also defer federal income tax payments due on April 15, 2020 to July 15, 2020 without any penalties and interest, irrespective of the amount owed. This deferment all taxpayers, including individuals, trusts, estates, corporations, and other non-corporate tax filers, as well as those who pay self-employment tax. In response to the coronavirus pandemic, the tax deadline for 2020 has been extended until July 15 for IRA contributions. Gives an extra 3 months to make IRA contribution for the year 2019. Taxpayers can make a SEP IRA contribution as late as the filing due date of the return, which includes the extension. So in a typical year, if you file a 6-month extension, you would have until October 15 to make a SEP IRA contribution. Filed by US persons to report, FBAR is filed by US persons to report financial interest or in a signature authority over a financial account located outside of US. The due date for filing the FBAR remains April 15, 2020, but pursuant to the previously issued guidance, an automatic extension is granted until October 15, 2020. I would also like to bring some light towards the area of charitable contributions. The CARES Act adds a new above-the-line deduction available in 2020 and future years for up to $300 of cash contributions made to a qualified charitable organization. This deduction is in addition to and it does not take away anything from the standard deduction. For the tax year 2020, the CARES Act allows qualified cash contributions made by individuals to be deducted up to 100% of their adjusted gross income. Qualified contributions are allowed as a deduction only to the extent that the aggregate of those contributions does not exceed the individual's AGI over the amount of any of the charitable contributions allowed as deductions for the year. Again, anything in excess will be carried forward to the next year and can be utilized in next 5 years. Another thing which is very interesting is regarding the student loans. There are two major changes made to student loan arena. If you have a federal student loan, you can suspend your monthly payments through September 30, 2020 without accruing any interest. This year, the employers may also choose to make tax deductible contributions of up to $5,250 towards your student loan payments, and you will not have to pay any taxes on these contributions. Next, I would like to discuss about the NOLs. Businesses and individuals who own pass-through entities that incur NOL in the tax years 2018, 19, and 20 can carry back these losses to offset taxable income for a period of 5 preceding years, preceding the year in which the loss was generated. Additionally, businesses can elect to exclude the carryback period for any years in which Section 965 transition tax was applied. The CARES Act now also allows 100% use of NOLs to be used against the taxable income. This amendment applies to tax years beginning before January 1st, 2021. What is new about depreciation? Everybody's talking about it. The CARES Act now allows for faster depreciation on qualified improvement property, as it is now being qualified as a 15-year property eligible for bonus depreciation instead of the previous qualification as a 39-year property. This provision may allow taxpayers to file amended returns and claim refunds for the year 18 and 19 if they have placed such qualified improvement property into service during those years, and may also encourage taxpayers to make needed improvements in the coming years as the economy recovers from the COVID-19 pandemic. Last but not the least, I would like to talk about Section 139 tax-free deductible payments. Due to pandemic, now an employer can pay workers to cover reasonable and necessary personal, family, and living expenses incurred resulting from COVID-19. Reimbursable expenses could include unreimbursed medical expenses, funeral expenses, increased utilities, home office expenses such as enhanced internet connections, computers, laptops, printers, office supplies, and even increased childcare expenses. That's it from me. Thank you, Subhash Bhai. Over to you, Bhakti.
Thank you, Khushbu. Stimulus checks were last used during the recession 2008. To combat the COVID-19 pandemic, the government has again introduced these stimulus checks to boost the spending capacity and to support the economic activity. I would like to request Subhash Bhai, a partner with Chugh CPAs LLP, to share some information on the stimulus checks and the retirement savings during this pandemic. Subhash Bhai.
Thank you. Economic impact payment is commonly known as stimulus payments. The payments are made based on two major criteria: income and filing status. Individuals filing a single with AGI under $75,000 will get a full $1,200 stimulus payment, and it phases out at $99,000. Married filing joint receives a $1,200 per adult and $500 for each dependent child, provided the AGI is under $150,000 and it phases out at $198,000. The cash payments are based on either your 2018 or 2019 tax filings. Eligible retirees and recipients of Social Security, SSDI, disability benefits, survivor benefits, railroad retirement benefits, and veteran benefits, as well as individuals who do not make enough money to normally have to file a tax return, such as recipient of Supplemental Security Income SSI benefits, are also eligible for the payments. US citizens, permanent residents, and individuals filing resident tax returns such as H1 and L1 visa holders are eligible for the payment. However, the dependents with ITIN and not having a social security number are not eligible. Stimulus money is generally not subject to a reduction or to offset to pay back taxes or other debts owed to the federal government. However, if you owe child support, the IRS can use stimulus check money to pay the arrears. If your child support debt is greater than your stimulus check amount, you could end up missing out on a stimulus payment entirely. If you have not received any payment this year, you can also file your tax return for 2020 and you may claim the $1,200 stimulus check at that time. The payments will be continued to be made throughout the year by IRS. Another topic we have is retirement benefits. Retirement savings plan. There are some significant changes made to tap your retirement savings. You can borrow up to $100,000 from your retirement savings account without a 10% penalty and pay the loan back in equal installments in 5 years with 5.25% interest. And or you can take a penalty-free early withdrawal distribution of up to $100,000. And if you want to, you may return it later within 5-year period, or you may just want to keep it. The required minimum distribution is another big change. The required mandatory distribution for age 72 and above are suspended for the year 2019 distribution due by April 15, 2020, and for the year 2020 distribution, which is due by April 2021. So there are some good changes done in retirement savings plan. Back to you, Bhakti.
Thank you, Subhash Bhai. So how does this pandemic affect our H1 employees? I would request Gulshan Chatta, our immigration attorney at Chugh LLP, to give us some insight on the immigration issues. Gulshan?
Yes, thank you. The first question here is regarding employees that are working from home if an amendment is needed. The answer to this will depend on the location. This is usually applied with the same MSA as long as they're working from home within the same MSA, which is usually 50 to 60 miles from the address listed on the petition. This should be okay. There will be a LCA requirement, so you would post a LCA at home for 10 days. An employer can post that same LCA on an electronic newsletter, intranet, or can email all affected employees a copy of the LCA. The next question regarding short-term placement due to COVID-19. The short-term placement allows employees to work outside the normal work site for up to 30 work days without filing any kind of amendment or LCA. The key thing to remember here is 30 work days, so it will be a little bit over a month, and you can do that without filing an amendment. The next question is related to the first question. How do you comply with the LCA requirements if your office is not currently open? You can do that. This can be done by posting the LCA on your website, email, intranet, electronic newsletter. You would also take a printout and put it in the public access file. And the Department of Labor has also given a 30-day extension for posting the LCA in the new work sites. For H-1B employees, they can take family and sick leave related to COVID-19. The key thing to remember here would be the request for leave has to come from the employee themselves and not from the employer. If it comes from the employer, it could be seen as a masked benching, which will not be permissible. So as long as the leave request is coming from the employee, this should be fine. In terms of reducing payroll, H-1B employer does have many options related to cost cutting as well as laying off the employee completely. If you do want to reduce the H-1B employer's salary, you would have to still pay them the prevailing wage. The key would be to file an amendment with the new wage level. As long as it is still higher than the prevailing wage, you could do that, file an amendment, and start paying them the new wage effective as soon as you file the amendment. You would want to create a new employer agreement in writing and have the employee agree to this new wage, so you have a record of this. There's also a way you can file an amendment and reduce the number of hours for the H-1B employee to part-time. However, you would still need the salary to match the prevailing wage level if you wanted to do that. There is another way to reduce cost, and this is usually done for a short-term period of time, where you would reduce salaries or hours for all employees. This will be H-1B employees as well as regular employees. This step is usually taken for a short-term period of time, and in extreme economical situations like the COVID-19 pandemic, like I said, this changes would be across the board, so it would affect the entire business workforce. You would have to notify every employee regarding the reduction in hours and salary. However, you are still required to pay the prevailing wage listed in the LCA. The key thing to remember is that these changes are made across the board, and it would be applicable to all employees and not just H-1B employees. And finally, there's the option to lay off the employee. If you do lay off an H-1B employee, you have to provide them return transportation to their home country. The laid off H-1B employee does have 60 days to make plans and arrange their affairs to depart the United States. In that time, they can apply. They could file a transfer to a different company if they would like. These are some of the options that they have if you do have cost-cutting issues relating to H-1B employees. The next question is, does H-1B employer need to pay an H-1B employee even if they cannot work? Yes, you would still need to pay this employee. Otherwise, it could be seen as a benching. Unless they've asked for leave themselves, you would still need to pay the H-1B employee. The next question, if an H-1B employee can no longer work because of COVID-19, if they cannot leave the country because of travel ban either here or at their home country, for example, if they cannot leave for India right now. In these circumstances, we are advising the employee to file for a change of status to a visitor visa. This would show a good faith effort on their part that they made in order to comply with the rules and not stay out of status. And if this is a problem later on, they would have documentation showing that they did make an attempt to change their status and did not stay in the United States on improper status while they were waiting restrictions of the travel ban to be uplifted. The next question is regarding the green card processing. Right now, green card processing can continue as it has been going. The only issue that might come up is when you file for a perm application, there is a question that asks if there were any layoffs in the company within the last 6 months. So if your company is laying off employees, this could be an issue when you file a perm later on within the next 6 months or so. The key would be here is what exact position was laid off, what salary were you paying them when they were laid off, and this would be very case dependent. And you would need to consult with an attorney at that time. But this is something to keep in mind if you are laying off employees, that this could be an issue with green card processing. Besides this, green card processing can continue as they have been during this pandemic. In terms of reasonable accommodation, one of them I mentioned earlier was the 30 days extension in regards to LCA postings. They have also made some accommodations when it comes to audits or prevailing wage determination requests, recruitment reports, which were essentially due between March 13th to May 12th. As long as a deadline was somewhere between that period and you file it before March 12th, they will accept it. So that's one of the accommodations that they have made. The second accommodation is recruitment for perms. Usually there's a 180-day time frame where it has to be completed within that time frame. They have given a 60-day extension to that. So as long as it's even if it's within not 180 days, you have an extra 60 days for that. So that's another one. And the third one, like I said, is the LCA requirement where they've given a 30-day extension to post the LCA at the new work site. That was it for me. Thank you.
Thank you, Gurshan. It was pretty informative. I would like to now invite Vikram Subramanian, attorney with Chugh LLP, to share some important updates about the employment laws under the Families First Coronavirus Response Act, FFCRA. Vikram?
First of all, thank you for everyone for joining today. I see we have a lot of attendees. The first issue is, yes, what are the reasons an employee can take time off for COVID-19? In this context, an employee qualifies for paid sick time if the employee is subject to a government quarantine order related to COVID-19, has been advised by a doctor to self-quarantine, is experiencing COVID-19 symptoms, and is seeing a doctor, is caring for an individual subject to a quarantine order, or is caring for a child whose school or daycare is closed because of COVID-19. Back to you. Another issue is whether employees can use sick leave before the FFCRA applies, and can they use PTO? The short answer is that an employee can be affected by COVID-19 has a right to use paid emergency sick leave under the FFCRA before using any PTO. Further, an employer cannot require the employee to use PTO first before using sick leave. Another question is, what is Emergency Paid Family Leave Act under the FMLA? This new law requires employers to provide employees the ability to take leave to care for a child who is out of school or daycare because of COVID-19. Also, Emergency Paid Family Leave Act under the FMLA can be used consecutively with paid sick leave whenever applicable. Another question people have is, how much will employees receive for FMLA leave? The answer is, an employee is eligible to receive a total of 12 weeks leave, which includes 2 weeks paid by the employee using their PTO or sick time, and the remaining to be paid by the employer equal to 2/3 of the employee's regular rate with certain caps. Another question people have nowadays is, which employees qualify for unemployment benefits? State law usually governs and makes a determination about who qualifies for unemployment benefits. But at this time, most people will qualify, including contractors and others who cannot find work. The federal government has already provided $1 billion in aid to state governments to support unemployed persons with no waiting period even. Employees do not even have to go in person, and there are no work search requirements to qualify for unemployment benefits. Lastly, laid off and furloughed employees qualify for unemployment benefits as well. They can receive benefits from the state based on a percentage of their salary plus $600 a week from the federal government for 4 months. The last question I'm here to address is, how can business utilize the force majeure contract clause to protect themselves during the pandemic? The force majeure clause is designed to free a party from a contract due to unforeseen events beyond the party's control. So in this context, we would argue that COVID-19 will qualify as an unforeseen event outside of the party's control. So even if a party's contract does not mention COVID-19 by name, other similar words used in the clause, such as pandemic, catastrophe, disaster, act of God, should suffice. So this pandemic outbreak would constitute a trigger of the force majeure clause, in our opinion. The affected party would just have to show it is impossible to perform the terms of the contract and prove that its non-performance was unforeseeable and outside of its control. You can also use doctrines of commercial impracticability or frustration of purpose to try to excuse the performance. I'm actually helping a client out on this issue right now and found some very useful case law doing legal research on this subject that can help anyone addressing this issue. So please reach out if you'd like to discuss further. And that's all on my end. Thank you, everyone. Back to you.
Thank you, Vikram. So this concludes our webinar. And before we move on to taking some more questions, I would like to request Nitin Parekh to share some words. Nitin bhai.
You have to see if he's on mute.
Nitin bhai, you may be on mute. Nitin bhai, yes, you're on mute. No worries. Thank you everyone at BVP. It was good to have present our webinar. We would like to take some questions. If you have any questions, please write them on your chat box or raise your hands. Some questions that we've come across that we would want to just go over so that it benefits everyone. One question that Ashok Seth, he's been asking for is what is about the EIDL status and the number 36 that we spoke about. So EIDL status, you can check it with the phone number that we've shared in the chat box. Also, the number 36, the SBA guidelines had issued certain form numbers at the beginning, and then they revised it. And the last number, the last forms that they issued had the number started with 36. So in case if you filed at the initial stages before the reforms happened, it may not be a valid application. So once you filed, you would have got a confirmation number saying XXS is your number. It should start with 36. You can call and they'll give you a status update. There are some questions. Nitin bhai, we can, you know.
Okay, sorry about the initial. Again, like to just on behalf of the Srimad Krishnadam, like to thank you everyone, the complete panel from the Chugh firm, spending your valuable time to educate us on this stimulus assistance and clarifying a lot of confusions. Special again, thanks to Subhash Bhai and Bhakti Ben for arranging this webinar. I think it was very educative, very well done. And the Subhash Bhai and Bhakti Ben always there to give their seva to the Srimad Krishnadam. It can be for tax purposes, fundraising, you name it, and they're always there to help us out. They also help us out in applying for the PPP program and the EIDL also. So again, once again, thank you on behalf of the Srimad Krishnadam. Please continue.
Thank you, Nitin bhai. We'll address some more questions before we run out of time. So one of the questions was the LLC owns rental apartments. The company is receiving 1099 for these rents. Can we apply for PPP? These LLCs have been owned by partners, not the employees. Kisle, please, can you throw some light here?
Yes, yes, Bhakti, the LLC owner can also apply for PPP loan, and their net profit in the LLC will become a payroll, and that net profit can be divided by 12 multiplied by 2.5. Plus, if the LLC has any other employee on the payroll, that can also be counted for this purpose and can be calculated for PPP loan.
Okay, thank you, Kisle. So there's another question which is being asked for is the state programs. What state programs are available to avail COVID-19? Asha, can you please share some information?
Sure. So the state, especially the Small Business Finance Center, the SBFC of the California state government, has started a few initiatives, as I was mentioning. One is called the Jumpstart Loan Program for people who wanted to start a new business or wanted to just branch out and start a new wing of business. That's a Jumpstart Loan Program where you can get anywhere between $500 to $1,000, $10,000. And the California Disaster Relief Loan Program, especially for the COVID situation, this has been initiated with the financial development corporations called as the FDCs, which provide these loans, and the guarantees work with the SBFC. So that's how it works. And small businesses anywhere between 1 to 750 employees, which have had any kind of an impact due to COVID, can apply for these. The guaranteed terms can go all the way up to 7 years, and you can get up to 95% of the loan guaranteed. Loan interest rates is all dependent between you and the lenders. And that is these financial development corporations. This is what has been introduced by them so far.
Thank you, Asha. There's another question for, are these loans forgivable? EIDL, PPP. Jyoti, please, can you share your inputs?
Sure, Bhakti. So as we mentioned, the EIDL loans are not forgivable, but the PPP loans are going to be forgivable provided they are being used as per the guidance, where it says, you could use 75% of the loan proceeds for the payroll. And if it was an S Corp or an independent contractor, you could use it for the replacement of your net profit, the net self-employment income. And the remaining 25% could be used for making payments like mortgage, interest, rent, utilities. And in that fashion, you could have the loan forgiven. Back to you, Bhakti.
Thank you, Jyoti. So another question is for the loan forgiveness. If there's only one spouse on the payroll, can you increase your payroll for forgiveness? Can you give extra bonuses? Kisle, can you help us with that?
You can certainly, I mean, there is no restriction in the law about forgiveness. I mean, you cannot add to your spouses or not do the bonuses. You can do it. Maybe you can call us and we can look into your situation more closely and guide you.
Thank you, Kisle. One continuing question for it is it okay to keep 100,000 salary, or should we reduce it to meet the forgiveness? What is it about the cap?
The salary can be anything, but only up to 100,000 will be counted. Let's say if somebody is getting 150K or 200K, then only $100,000 equivalent payment to him for 8-week period, which could be roughly about maybe $15,000, that will be counted for the forgiveness amount.
Thank you, Kisle. We'll take one more last question. Rental contracts can be unpredictable. Can be the unpredictable circumstances. Can we apply force majeure in it? Vikram, can you help us with that?
Yes, I mean, thank you very much for asking that question. In fact, when I made reference to the force majeure issue that I'm helping a client on, it is related to a rental contract. So whoever out there is asking that question, yeah, definitely please reach out to me, because I think it's a very viable defense. I mean, there's no guarantee it'll work necessarily, but it's a strong one. So I definitely encourage whoever's curious about that to get in touch with me. Thank you very much.
Thank you, Vikram. So I think we'll end these questions here. If you have any more questions, please feel free to reach out to us. Our information is out here on the slide. We will be sending these webinars to you all. It can be available even on our website. If you have any questions relating to COVID-19 and how we can help, please visit our website and you'll be able to access the COVID-19 page out there. And we'll be happy to help you all in any ways. Thank you so much.
Thank you, everyone. Thanks.
Thank you.